Woke up in Brizzy yesterday, which was the first leg of this trip, and this is my first go on stage. So, as you do, most people in the room, you wake up, you turn your phone on, and you see what's happening, straight to the overnight markets. And I turned my phone on, and it was absolutely red. Stocks were down, indexes were down 3 or 4%. The tech stocks, the growthy stocks were down a lot more. Your favourite car manufacturer was down 15 yesterday morning, and my little value heart sort of went tickety-boo. Here we go, my first big Pinnacle presentation and the blood on the streets. I said, what do I do? I said, do I change my prezzo, try and slip the March numbers in? I said, no, you can't do that. The presentation was lodged last week. Okay. I said, well, what would the cool kids do? I said, the cool kids would probably use AI. Now, Dougal's not a great user of AI, but anyway, I pulled up ChatGPT and typed in after big falls in world equity markets, how does the value fundy start his presentation? And the bots whirred away. You probably felt the electricity go through those Goodman data centres at 7:30. No, I was in Brisbane, 6:30 yesterday morning. And the bots spat back, be grateful and thank your hosts. So thank you, Pinnacle, for organising my debut on a week which is, lots of blood in the streets. I'm both the new boy, new kid on the block, and arguably the people who laid the pavement. So why do I say that? I'm the new kid on the block because my company, Maple-Brown Abbott, was acquired by Equities partners late last year, and hence we became a Pinnacle affiliate. So again, thank you for having me here today. My reference to laying the pavement, and Emily kindly referred to it, we were the first boutique funds management company in this country, established in 1984. So we have over a 40-year track record, and we'll show you that in a minute. What do? We're value. You'll hear that a few times. Not many value guys left, frankly, which is an opportunity itself, I'd put to you. Long-term, bottom-up investors, we take a 4-year view, not a lot of science in that. A lot of people looking at next month, next quarter, next year. Some people try to forecast 10 years. We think that's a bit difficult. And most importantly, we've got contrarian. So in our view, the way to make money over the long term is to go against the crowd. And that's how we make our money. I thought I'd try and explain to you how we do it using the resources sector. So the Aussie equity market, in my simple terms, is 3 buckets. Roughly 25% in resources, 25% in banks, and 50% in all the stuff I period invest in. No, the other stuff, the industrials. So resources moves over time, obviously, roughly 25% of the market. Simple chart, the brown line is the price to book of the resource sector over time. It's going back 25 years, which is actually when I joined the firm. The blues are the unders and overweights of this fund to resources over time. I've only got a limited number of minutes, so I'll give you the quick version. 2000, tech boom. We didn't like tech stocks, not surprising. Some things haven't changed. We were heavily overweight resources. They were reasonably priced at the time. Next decade, resources had a huge run. China industrialised. It peaked at about 4 times book. I think it was when BHP actually made a bid for Rio Tinto. By that stage, we were roughly 50% underweight resources. Okay, valuations change, we go heavily underweight. The next decade, and it wasn't quite a decade, more like 8 years, was the complete reverse. Resources had a miserable decade, culminating in a dam bursting in Brazil in late 2015, December 2015. Big numbers, BHP went from $50 down to 12. It's quite a fall, good time to be underweight. By the time they bottomed at roughly book value in January 2016, we were then 50% overweight. And I've told people before, the hardest bit of my job is not looking at the price to book. Okay, I've got teams of analysts who can do that for me. Frankly, you can get it from a stockbroker or a Bloomberg terminal. The hard bit about my job is convincing yourself, frankly, when everyone else is telling you the world's going to end, or the world's going to go to the moon, or there'll never be another apartment built in China, or this time it's different. If I had $1 for people who told me that over the 25 years I've been doing it, I'd be a rich man. To go in there and trust the valuations. So taking that downside, for example, we had to go in when BHP was $20 and the next day it'd be 19, and buy what we lost yesterday and buy some more to go more overweight as the valuations improve. Timing's impossible, so don't ask me for timing. Frankly, don't ask anybody about timing, but anyway. Pretty much at the bottom, we were 50% overweight. The next 10 years have generally been pretty good. Stocks have been re-rated. BHP's gone back from $10 to 50, probably adjusting for a few flows. And today we're about neutral weight. I won't go into the intricacies today of got a bit less iron ore and a bit more energy, but that's what we've done for 40 odd years. Proof's in the pudding, as they say, mate. This fund has been around since 1986, and again, Hyperion have got unbelievable 20-year numbers. This is almost 40 years. The top ones are gross, to be fair. The fees today are 80 bips. Fees are a bit higher in 1986. Wish I'd been born a few years earlier, which we all did probably. That was a joke. 2% per annum compound gross over 40 years is no mean feat. We have launched another one, Value Opportunities Fund we call it. As a bit of a flavour of the month. I mean, it's 5 years old, so it's not that new. More mid-cap, more concentrated, less top 20, higher active share. And that also has done pretty nicely over the intervening period since it's been listed. Okay, rest of the market. I've talked about resources quickly. The market as a whole, and again, this is why I want to update my slides a bit, still looks a bit toppy, about 20% above the average. Again, this is probably 2 weeks old. That number would be lower today. Within that market, so the industrial bucket looks exceptionally toppy, although not quite as bad as it did in the peak of COVID. So the peak of COVID, lost the last of my hair, industrial stocks on average traded at about 30 times forward earnings, on average. So CSL on our numbers, on market's numbers, peaked at about 50 times forward earnings. That stock's had a miserable 5 years and now down to about 22. Anyway, today the industrials still, again, it's a couple of weeks ago, were roughly 30% above average. So again, not particularly attractive. Within the industrial bucket, we are finding better value amongst the defensive stocks. So very simple chart, listed names across the bottom. Some we hold, some we don't hold, some our competitors hold. Relative PE relative to the market. So the defensive stocks are trading cheap relative to the market. They have the added benefit of being defensive. So if you're a bit nervous about the geopolitical situation, if you're a bit nervous about the economy, the defensive stocks should do better, and indeed they have over the last month or two or three. One more layer of the onion. Within the defensive stocks, we don't just go and buy the whole lot. We're value guys. We've owned Coles for a couple of years now. We have not owned Woolworths, so the two big supermarket chains. Why did we pick Coles over Woolies? This is my shortest term graph. It's not my fault. Coles has only been listed for 5 years, so it was spun out of Westies just before COVID. This graph goes back roughly 5 years. At that time, Woolworths was trading at 30 times forward earnings, which frankly at the time was not dissimilar to the average industrial stock. Coles was the ugly sister, duckling, whatever, trading at 22 times earnings. Hence we went for the value play. Intervening 5 years, as Dom's already alluded to, Woolies has had a miserable time, some of their own making. You can see Woolies has been derated dramatically, and today the PEs are frankly within forecast error of each other, roughly the same. So Coles has been a good holding. Frankly, I reckon we'll be looking at Woolies shortly. It's been derated a long way. There's nothing wrong with the company. It's stubbed its toe a few times. But that's the sort of opportunities we're seeing within that industrial bucket of the Aussie equity market. The last bit, which has frankly been the bugbear of most active fundies over the last little while, are the banks. Maybe put your hand up, think Aussie banks are expensive. I've got my hand up. I'm underweight today. A few hands up. Probably put your hand up if an Aussie fund manager told you they're expensive a year ago. And there'd be a few hands again, and probably more if you said 2 years ago. What's happened, which is, you can still make money out of valuation. This is the return of the major Aussie banks. It's not quite 2 year time period. The dots are the total return. So, Westpac and CBA have put on a cool 50, 60%. ANZ and NAB slightly less. The brown stream there is Dom's dividend stream, so don't forget your divvies. And also don't forget the numbers I showed you earlier on, ignore franking, and I reckon franking adds about 1.5% to our funds per annum. So the brown's the dividends, so fairly consistent, CBA a bit lower, others a bit higher. The bit which you really need to see your glasses, and my eyes are bad, another brown colour is the earnings growth. Basically, it's non-existent. CBA is a very small positive, the other three are very small negatives, and the vast majority of the returns have been a PE re-rating. Okay, so those blue columns is the valuation re-rating over the last 18 months, which has caused this huge run in banks. That's great, mate. This is my final slide. What did you do about it? And I'll only go back 2 years here because I'm about to run out of time and they knifed me or something. Don't get my main. 2 years ago, so it's May 2023, most Australian banks report in May and November. The sector was on its knees. People were worried about a hard landing, soft landing, mortgage wars. Macquarie were doing this, ANZ were doing this, and the banks were on their knees. At the time, the sector, which is the brown line price to book on the right, was about 1.3, 1.4 times book, but that includes CBA, which even I thought was ridiculous, and we don't own any CBA. At that time, 2 years ago, ANZ, Westpac were trading on 10 times earnings, 1 times book, and a gross yield, including franking, with a 9 handle, so 9 point something. Okay? We bought a lot of those banks, and including a fair bit of NAB, and have enjoyed this huge run in the last 18 months. Today, you can see we've moved, by our standards, pretty damn fast as those valuations got back to 2016 levels. Also point out on a price to book basis that the ROEs today are much lower. We are now heavily underweight banks today, roughly 6%. I'm out of time. Thank you very much. It's times like these you might be grateful to have a value fund manager or two. One will be enough, us. In your portfolios, please have a look at them and speak to the people hanging around the edges. Thank you.